Today I'm going to be talking about Boeing's valuation and how it could be a good short idea or how you can pair it together with long short equity idea because later I will have a video coming out about airlines. And so this is a good short idea. If you want, you could do it as a naked short. You have more risk right there where the rest of the market might go up. And so Boeing might go up with it even though from bottom up perspective it isn't as good as the rest of the market. So you might want to try to do long short equity on this. Or if you think that the rest of the market will go down, this is a way to bet on that. So first things first, from bottom up perspective, let's look at the moat. Obviously, if you're doing top down, you're going to look at macro first, but usually when you're doing valuations, you just do it from a bottom up fundamental perspective. So moat and competitive advantage, that's the first thing that comes to mind. Boeing is one of the few in the sector, but does this justify the valuation? So it has both a brand moat and it has a moat in the sense that it's very hard for competitors to come in because it's expensive and complex to do the things that Boeing does. On the other hand, I want to look at risk. Boeing doesn't earn anything, so we want to look at the cash pile and the cash burn to see how much cash is burning away and how large this cash is currently. So cash equivalents 9.5 billion, cash burn is 4 billion annually. And so it's good for the next little over 2 years and it has no risk of bankruptcy anytime soon. Its debt is at 40 billion. Debt of 40 billion is a bit worrying right there. And so in the short term, not a big problem, but in the long term, 3-4 years from now, this becomes a very big problem right here if it doesn't start earning anything. So of course you have that moat, but on the other hand, it doesn't earn anything, and so you have a lot of risk right there too. So you have to weigh those out. So return on assets, return on equity, return on assets 2.5%, and it was making 8% a year ago. So if Boeing's able to fix the 737 MAX, it's able to bring it back into production, they might go back to the 8% return on assets again, but 8% is still fairly low. Whenever we're looking at the average, we would generally see the average return on assets be about 10%. But when you're looking for these sorts of value investments, or even if you're looking for a shorter term swing trade, you want return on assets that's far higher. And then return on equity currently is negative. And again, this goes back to the debt thing. Return on equity and return on assets, main difference being the return on assets looks at assets and how much they return. Return on equity will look at the owner's equity. And so assets minus liabilities equals owner's equity. And so the assets are returning something positive, but then the liabilities, they're really bringing it down. And that's why return on equity looks at the return that the owner's equity has. And since assets minus liabilities equals owner's equity, the owner's equity is giving a negative return. And it has been this way for a while, before the 737 MAX problem even came into consideration. And so since return on equity is negative, this really shows that since return on assets is positive, but return on equity is negative, the difference being that return on equity takes into account the liabilities, because assets minus liabilities equals owner's equity. And so this shows, again, you have a large debt pile, and Boeing is not using its debt in a productive manner, because there's nothing wrong with debt as long as you use it in a productive manner. Boeing is not doing that because the return on equity is negative, but return on assets is positive. So clearly its assets are making something, even though it's not very big, but it can't use the liabilities in a productive manner. Current free cash flows aren't enough to pay for dividends, and so I'm expecting a cut if earnings don't get positive anytime soon. And even if they do, the dividend is going to be a large amount of the payout ratio, and so you won't see much appreciation. So either way, they're going to have to cut the dividend, or they're going to have to get into more debt to pay that dividend. Whatever happens, this thing's going lower just from that perspective. It could go up in the sense that if the rest of the market goes up, since this is part of the Dow component, the Dow Industrials, if more people buy the diamonds, the DIA, Dow Industrials Index Fund, then this could go up because of that. But just from a bottom-up perspective, it should not be going up because the dividend will likely be cut. And if that isn't, they're going to have to go into more debt to pay that dividend, making the problem worse. So growth and contraction cash flows Remember, valuations are based off of current cash flows relative to future cash flows, relative to the risk and reward of those future cash flows. So current cash flows are negative. Then future cash flows, you want to see whether there's going to be growth or contraction of those future cash flows. And then the risk or reward of that. And so the risk or reward would just be how much risk is there, or is there the opposite in the sense that it isn't very risky. The cash flows are not very risky. So of course this goes back to how you look at PE ratios. A company might have PE of 5, another one might have PE of 20, but the company that has a PE of 5 might have riskier earnings, or it might have earnings contraction in the future coming. So those sorts of things are what you want to look out for. When it comes to growth and contraction cash flows, the current sector growth trend is 3%, and that's just insignificant seeing that the risk-free rate is similar to 3%. And so if the sector is growing at 3% a year, the risk-free rate is 3%, so it really doesn't matter because we want to use discounted free cash flows to do this valuation. And so if you discount the cash flows, to discount, use the risk-free rate to discount the time value of money, but if the risk-free rate is the same as the growth, then it doesn't matter. The Boeing's growth rate is currently negative, and even if they get 737 back on production, I think that initially you're going to see a spike in growth because it's back in production, but afterwards it's going to plateau if they don't continue making more and more and more consistently time or time again, or they come out with new products that people are willing to buy, or that it wouldn't be people, but the airlines and the US government, because they oftentimes do military related things, are willing to buy. Coronavirus and the end of the long and short-term debt cycle, there are significant macro barriers Boeing has to face. So macro barriers are one thing. Growth rate is currently negative, so it's in contraction right now. And even if it gets to that sector growth trend of 3%, 3% is nothing because inflation is is at 3%. Also, even in real terms, we look at the time value of money. 3% is nothing because that is the time value of money. So you can't even discount the growth in the secular trend that the sector has. And Boeing is under that right now. And even if it gets 737 MAX back in production, which is very unlikely, first off, that's going to do that in the short or medium term. Even if it does that, though, the growth is going to be very slow. So what's the valuation? I think 120 is a good valuation. This, of course, is 1/3 of the underlying value right now. And so that takes all the above into account. I took a little bit of the end of the business cycle into account, not all of it though, because here's the problem when you're trying to guess macro. First off, you might be wrong, business cycle might not end. Another thing is that looking at the business cycle, it could be an inflationary or deflationary recession. If it's inflationary, then Boeing would actually go up because the dollar would weaken significantly because you'd have hyperinflation. So taking all that into account is very hard to do, but I did take coronavirus into account as such, and 120 seems like a good valuation. And with that said, you can short it, but obviously if you want to short that, you might want to do a long short equity portfolio because if the rest of the market goes up, Boeing will likely go up too. In 2019, the rest of the market went up. When we're talking about American equities, American large cap equities went up 30 to 40%. Boeing went up 3%. So clearly not as much, but it still went up. So you don't just want to naked short it. You probably want to do a long short equity, or you want to use some options to do a trade. So mitigate that risk that the rest of the market goes up and Boeing goes up with it, even though it might not go up as much. We're going to be doing updates on this, and we'll have similar valuation videos coming out. So subscribe if you want those. And other than that, happy trading.